Looks like you're in a good
Morning,
mood.
David. Good morning, Yvonne. Likewise.
Do we buy this dip?
Let me tell you a bit more. You start the question, and I'll answer you more. Okay. I think the key message today is I think we still see more downside risk coming even from this level. I think the worst has happened for some of the sectors, but obviously it looks like to me, or at least to me, or to us, to a lot of investors, that Beijing may have been trying to refocus a bit more on the non-tech side, having a lot of subsectors being affected. We have seen education names yesterday. We have seen food delivery. We have seen the platforms in general, antitrust. And I mean, the ripple effect, it could be getting to other sectors, including even like healthcare, health tech, or even property, with the, I believe, the top agenda coming from promoting higher birth rates, supporting employment, supporting GDP growth level. We could see more and more of those regulatory tightening continue to happen. Yeah. So in short, some of the sectors, it may not be a good timing for bottom fishing yet. Yeah.
You're saying right now, this is not panic selling. What are you really seeing there in terms of why people are fleeing these stocks? And when it comes to just what to look out for, do you see further correction?
Okay, I think what I was referring to, not a panic selling yet, it's probably outside Hong Kong, China. I mean, we have seen a lot of fund outflows, including the well-expected names like education, probably since first quarter of the year. It's all publicly available information with all the big funds like UBS selling into education names. So we have seen that already. But if you look outside of Hong Kong, China, there seems to be investors seems to be still very selective in terms of trimming the sector exposure. So that's why, in general, we're probably not seeing a panic selling as a whole yet. But then I think the concern or the risk now is probably coming from, will there be more, or has the market pricing enough of a redemption risk or outflow risk, either based on performance or because of index allocation, asset allocation?
Catherine, have we seen something like this before? When was the last time China actually kneecapped an entire industry like this? What sort of historical analogies are you looking at now?
No, I think this time is probably quite unprecedented. And I think for investors, probably resetting the expectation, it's more of the terms that we're using now. So the new normal would be that could be a more permanent of a structural damage to at least the internet tech sector. So we may be having seen more of the rotation back to sectors like new energy, vehicle, autonomous driving. So the question would probably be extended to, so what sort of the sectors are like having less vulnerable regulatory risk? Probably something that China wants to have tighter grip on that, or stronger support, or make sure that there will be a lesser reliance on overseas resource in terms of the technology side. So sectors such as autonomous driving, smart transportation, new energy vehicle probably are some of the sectors that could be less bad in terms of regulatory risks. The last round of regulatory tightening is probably about 3 years ago, when we have seen the content tightening approvals, or even the 2019 rounds of suspension of online games approval. But then this time, it seems to be more of a structural change, because last round of policy tightening, that's more targeted for smaller subsector. But it seems now to be a ripple effect to basically the overall ecosystem.
Yeah, Catherine, I was about to ask you then, when you look at your research then, in terms of the earnings forecast, we're moving into earnings season. So I'm looking at MSCI China. Earnings growth expected 40%, 16% full year 2021. If the market's derating and rethinking the bigger part of that index, can I trust that 16% earnings growth number?
Okay, but it this way, we can't quantify accurately yet, but then if you think of the index weighting itself, right, over 50% are coming from all these internet tech companies. So if we assume, more conservatively assume that there will be about 12 to 15% earnings cut because of regulatory tightening, either coming from the increasing staff costs from the insurance side, on the human resource side in general, well, basically compliance costs, we could easily assume there could be another 10 to 15% of an earnings downgrades coming from the tech companies for
Katherine,
2021.
final question. Yeah, we in the media, we tend to over-obsess over certain things. So we just talked about education, tech, and everything else. Is there anything that we haven't brought up that you think people should be aware of? What looks undervalued to you? What else?
I think probably as one of the interview that you guys just had, I think the MSCI Hong Kong is probably something that we might have overlooked. I mean, don't forget, as you said, NTR has actually outperformed the MSCI within the MSCI Hong Kong index, right? That's probably to do with the domestic recovery. And we're probably seeing good numbers, or well, less bad numbers from the retail landlord side. If you look at Hong Kong, right, we are progressively opening up. So this is probably something that some investors might have overlooked. So we might have to revisit the retail landlords in Hong Kong.